Good evening, everyone. I think the main risk with going last is that you've already seen a frog, which I thought the probability was low, but there we go. Well done, Russ. We're on brand. So I'll give you a bit more background to the frog and flesh it out a bit more. In the 19th century, there was a myth that you could put a boiling frog a frog into boiling water and it would try and jump out straight away. But if you put a frog into cold water and you slowly crank up the heat, it doesn't feel anything, it doesn't sense the danger, and it doesn't try and jump out. Now, that unethical experiment was actually repeated, and it's since been found that that is a fallacy, and luckily the frog does get out alive. But the metaphor itself is highly instructive, and it's human nature. That process of not noticing a major change, if it happens in small increments that are barely perceptible, is normal, and it's highly instructive about today's market. Tonight I want to talk about how 2022 was not the aberration, but rather the preceding decade was the abnormality. I also want to talk about what's changed in the last 12 months and why inflation and interest rates being higher really marks an inflection point. And then finally, what does this mean? What does this mean for investors? We talked a little bit about last year. I've actually put gold in sterling terms because I'm assuming most of you live in the UK. So gold did a little bit better if you were British. But it was amongst a very, very small number of asset classes that did. It was the year that saw almost all fall simultaneously. And clearly we know if you were long energy, also US dollar cash, or if you had some corn last year, then last year was probably your year, and congratulations. I think for most other people, it was not particularly pleasant. The context to this, though, is really important. From 2009 to 2020, we had quantitative easing, zero interest rates, negligible or negative, in some cases, yields on government and corporate bonds in some places. And this just led to appetite for risk. Equities became the only way to make a return, the only game in town. And that was briefly interrupted by COVID, but what was painfully long for most human beings, COVID for the stock market, was short and sharp. Policymakers, like with the financial crisis, rode to the rescue. And so actually that just catapulted markets higher. And 2021 is what we'll probably look back on as that final denouement, where, as Russ mentioned, meme stocks, Bitcoin bubbles, some really remarkable phenomena started to spiral out of control. The good times for bonds go even further back. And up until August of 2020, the bond market had had 40 years straight of a bull market. So we start 2022, and everything's expensive. There's nowhere to hide, but also investors have forgotten. They've forgotten what it's like to have a protracted bear market. And in the case of many, they've never actually experienced one. So the US stock market fell 19% last year. That took the froth off the top. That reversed the gains of 2021, but it took us back to where we were in 2019. So we're back to where we were when the bull market was 10 years old. This is not a reset. This is the price to earnings multiple on the S&P, and this is now higher with the exception of that 2020-21 period. It's higher than it's been since 2002. It's more than double what it was in 2008. And when we talk about valuation multiples, exactly what is being multiplied we have to ask. And in this instance, it's earnings, but it's earnings that have trebled since 2008. So we haven't experienced recession other than COVID, so we haven't had a proper recession, and earnings are still forecast to grow for this year. So there's nothing like a downturn being priced into markets. And maybe that growth will happen. But it gets a lot harder when the context is this. This is the change in the federal funds rate, and US interest rates are probably the single most important input into asset prices around the world. This, a year ago, was 0.25%. It is now 4.75%. That's dramatic. And it's dramatic versus all of the other rate hiking cycles that we have seen in the last 40 years. This has to have consequences. This impacts not just on valuations, where the cost of capital has risen, it also impacts on the real economy. Commercial lending, mortgages, all roads lead back to that interest rate. So we have this occurring in the background, threatening economic growth. We have earnings expensive levels. And we have the opportunity to invest in risk-free assets now at attractive returns of nearly 5% for short-dated government debt. And so are investors giving up on equities and taking this opportunity? The answer is they are far from throwing in the towel. And this is the ARK Innovation ETF. This is the ETF that is run by Cathie Wood. It invests in some fantastic businesses, many of them growing very strongly, many of them quite expensive, and actually some of them not profitable, so quite hard to value. And you can see the likes of Tesla, Zoom, the telemedicine company Teladoc on the right-hand side. And the thing with COVID and the financial crisis is that investors are now hardwired to thinking that help is at hand. Interest rates will come back down. Asset purchases will come to the rescue again. But the shares outstanding in ARK have not budged since 2020. So although the share price last year was down from its peak 75%, investors are hanging on to this hope that policymakers will once again bail us out. And so the asset allocation shift hasn't happened. We think it's going to probably take more time and a bit more pain in equity markets before there is a shift, but also before investors realize that the cast of characters has changed. And you might recognize the lady on the left. This is Tina. She's a singer. She's also an acronym standing for There is no alternative. There is no alternative to equities. And that certainly was the case. But now we are delighted to welcome back Tara. Tara, pictured here from her American Pie acting days. Some of you may be familiar with Tara Reid. But also Tara, there are real alternatives. And today, we're pleased to be seeing them. Our mandate is capital preservation. And when we're offered a bird in the hand, we take it. This is an opportunity now to lock in at a risk-free return in government debt, inflation protection for the next 10, the next 20 years. I've used the 10-year US government bond that's inflation-linked in this slide, and you can see that the real yield on this is now over 1%. It's now around 1.5%. And what this means is if you buy this today and you hold it for a decade, you will generate a return of 1.5% per annum, plus whatever inflation turns out to be over the life of this bond. And with a recent history of having no decent returns available from bonds, but also now having inflation there as a risk, we think this is really attractive, and we have reinvested some of our dry powder into the index-linked market. The reason inflation protection is cheap is that rates have gone up to combat current inflation, but ultimately long-term expectations haven't budged. The expectation is that inflation is going to come back down to where it's been, stable for the last 40 years. And I recently saw someone use the following chart to illustrate that argument. Are we back to normal? Well, if you use the precedent of the 1970s, you could argue that yes, inflation peaks and then it comes back down. But if you fast forward from this particular graph, and this ends in 1976, I think the lesson from the 1970s is be wary of claiming victory too early. This is 1978 to 82. And we're concerned that even though the short term is anyone's guess, the next few years are going to see inflation higher than it has been. And that's not being priced in to assets yet. The backdrop has changed, and it's changed when it comes to wages. And I think you mentioned this in the previous presentation, but really that wage component is absolutely vital when it comes to sustainability of inflation. If that changes, demand changes, and this becomes sticky. And we saw before COVID this discontent with people who live off their earnings to live versus those who had made a lot of money from QE, but ultimately the owners of capital who had made money at the expense of labour for the preceding decades. And now when we had the vote for Trump, we had Brexit, we had Corbyn, we had Bernie Sanders, all gaining traction prior to COVID. But then the pandemic happens and people are being paid to stay at home, sometimes to work, in many cases not. And so we come out of the pandemic and a lot of people decide that they don't want to go back to work. We have a shrunken labour force, but we also have people with different expectations. And those that did return are also facing a cost of living crisis. That cost of living crisis has materialized on the back of a lot of factors that were specific to COVID. So specifically the lack of supply chain bottlenecks, but also demand coming out of the pandemic was strong because people were supported well by governments during that time. So you have this cocktail of inflationary forces at the same time that labour is now demanding a pay rise and is able to do so. And so the negotiating power has changed, the scales have tipped. And you can see that in wage inflation, which is happening. You can also see it in strike action. And this is the number of working days lost to strikes in the UK. Last year it got to 1.5 million. So this is in the public sector, and wage inflation is likely to follow. We suspect we're going to struggle to simply revert back to the world of the 2009 to 21 period. And this is the reason we have for as our biggest exposure in the Trojan Fund, but also Personal Assets Trust and the Trojan Ethical Fund, index-linked bonds. This is 35% of the Trojan Fund today. And really, at valuations that were being offered now, we think this can deliver really decent prospective returns. We also have 11% in gold. And again, this may be controversially, but it is the one currency that cannot be printed by central bankers. It's finite in its supply, and we believe it's going to protect us in a more uncertain period for monetary policy, but also equity markets. It tends to behave as that safe haven when equities are more challenging and more volatile. We have a low 20s% weighting to equities. That reflects our concern over valuations today. It's also the lowest that we've had since the fund has been fully invested. And it's down from 45% in the spring of COVID. So really, we've taken profits in the last couple of years. We still believe that owning stakes in the best businesses we can find at good valuations will make investors the best money over the long run. But we think when the risks are too high, particularly when it comes to valuation, we'd prefer to stand on the sidelines. And so today, we are doing that in a big way, but also now we're being paid to by investing in index-linked, but increasingly in the other pillars of the portfolio, which include gold and now liquidity, that we invest in short-dated treasuries and short-dated gilts. So the Trojan Fund is run alongside Trojan Ethical Fund and Personal Assets Trust, which is our investment trust. That's the closed-ended version of our multi-asset strategy at Troy. I'm the fund manager on the Trojan Ethical Fund, and I'm the assistant fund manager on the Trojan Fund and on personal assets. And our team is run by Sebastian Lyon, who founded our firm, Troy, in 2000. And at the time, he was given the very clear brief to preserve the money of one family, to not lose their money, which focuses the mind. And 22 years on, we have many more families, many more individuals, charities invested in our funds, but that mandate remains the same, to protect what they have and to grow it over the long term. We won't necessarily make money or beat the market in every environment, but over the long term we have compounded at around 7%, and the drawdowns have been less painful than those of the market. You can see here in each of the major crises for financial assets over the past 20 years how the fund has fared versus the FTSE All-Share. The global financial crisis was the worst for both of us, and the Trojan Fund fell nearly 14% from peak to trough, at the same time that the All-Share fell 46%. So our job going forward is to protect what's already there, but also to capitalize on the opportunities that present themselves. And when we look forward, and I'm aware that this conference is about feeling good, there are silver linings. It's not going to be straightforward. We know that investors will probably take some time to adapt to equities being more expensive, particularly in the US. And for that time period, we want to stay low in equities. But we think, unlike the proverbial frog, that equity investors will jump out. They will realize that with inflation as high as it's been since the 1970s, with interest rates having risen to the extent that they have, and with valuations still above their long-term averages, something has to give. But that silver lining is that there are alternatives now. And we have been leaning into risk in inflation-linked bonds, and we will continue to take those select opportunities as and when we are paid to take them. Thank you.